Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to episode number 32 of the Wall Street Lab podcast. And this week we are talking about total return investing. Andy, why don't you tell us a little bit more about who we're talking to this week?
Sure. We talk to Iven Kurz, who is the founder and CEO of Evergreen. It's a startup that is dedicated to solve the retirement gap in Germany. And he uses a very particular technique, which is called dynamic passive investing. And it's a technique based on total return or portfolio insurance investing. So he uses the Black-Scholes model for investing instead of for trading. And we really get into the weeds on how does this help to lower your drawdowns? How does this make the portfolio returns very predictable depending on the market environment? And I hope it's an exciting episode for you. Enjoy it.
Yeah, and before we jump in, if you like what you hear or if we helped you in any way, please let us know by leaving us a 5-star review on iTunes or wherever you get your podcast. And now, without further ado, let's jump in.
Hi, Iven. It's a pleasure to have you on the podcast. I'm really excited about today's episode. We like to start off with telling people a bit about your background, and usually with a question like, what do you do in finance? How you would explain it at a dinner party that you're attending?
Yeah, hi, Andy. Nice to be here. What we do at Evergreen is we are helping people understanding their financial situations in the present and in the future, what they can expect from their income today, as well as in the future. So we're looking for a hassle-free retirement planning for everyone.
Okay, that sounds awesome. Can you tell us a bit more how you arrived where you are today, like a bit about your background, what you did before?
Sure. I studied financials and marketing a couple of years ago. And then I started as a portfolio manager in Frankfurt at Metzler Bank. And so I learned true portfolio management, especially fixed income management. And then I specialized in total return and portfolio insurance products. And then I moved on to the Lampe Bank and basically did the same as a portfolio manager, managing portfolio insurance products and total return products. Yeah. So, and then, that's it.
Okay, perfect. You mentioned two things that I quickly want to honestly jump right into. What is the difference between active investing, funds, passive investing, and what you did, portfolio total return?
That's three different things. Well, it depends on what you mean by investing passively. What I understand under investing passive is you don't do stock picking or bond picking. You're replicating a market, respectively an index, preferably the whole equity world in a passive, well-diversified way versus actively picking single stocks and bonds. Then managing portfolios dynamically can be two different things. One could be it's not passive because I'm picking stocks, or it's really dynamic because I change the asset allocation in a dynamic way. So how much equity, how much bonds or fixed income, how much cash. So managing asset classes in a dynamic way that are built into the portfolio passively by replicating indices.
Okay. How did you end up doing that? Like, what was the path that led you there? Why did you start? Why did you not become an active fund manager? Why fixed income? Then why total return?
It's kind of funny because I was hired to become an active bond picking fixed income portfolio manager, but that didn't really work out for me because I couldn't imagine forecasting the future and in this particularly way, fixed income interest rates or prices of bonds. And I guess it's kind of like a philosophical question, but I don't see how you can predict the future, whether it's the weather of next year or the lottery or your prices, bond prices. And I got this feeling pretty soon, probably a couple of weeks after I started. So basically, I talked to my boss back then and said, well, I don't see how this is going to work out. How are you going to know what's going to happen in the future? How would people know what would move an equity price 2 weeks from now? There's so many impacts on prices. How on earth would they know? And he didn't really come up with a question that was answer that was satisfying. So we started developing forecast-free approaches, and that was kind of the starting of the forecast-free total return approach that I am following until today.
So basically, you were not sure about the current way, and then you approached your boss, hey, let's change something, and he was open to that?
He was thinking about these things before I arrived, asset manager, but I think, things came together, and then we just started doing this and focusing on this. And what is really funny, that was in 2002, and we were thinking about portfolio insurance strategy for government fixed income portfolios, which from today's perspective really looks strange because yields were up at, I think 10-year bond yields were at around 7%, and everyone was afraid of a yield hike back then. Now with negative bond yields, it's really strange. But since then, yields kept falling and bond prices kept rising. But still, the fear of rising yields was already present back then, and it was a really successful portfolio.
How would you construct portfolio insurance for a fixed income portfolio? There's
many different ways. We kind of found our own way. One way could be like forecast based. You could just try to predict the future and say, okay, I don't know, next week yields would be rising, so I implement some kind of hedge into the portfolio. This is obviously not going to work very well unless you really have this glass wall that helps you predicting the future. Then there would be an approach, kind of like stop loss. You have a loss level, and then you just start selling when yields start rising. This is kind of hard because you get out of the market when you hit your loss level, but nobody will ever tell you when to get back into the market because yields might fall again in the future. So this is kind of hard. So there's some common strategies on the market, like a CPPI approach, where you define a risk budget, which helps you limit your losses. It has some constraints and some shortfalls, especially when you're out of risk budget, and you have kind of the same problem when you hit your stop loss target, because once your risk budget is gone, nobody tells you when to invest new risk budget in case yields would be falling, prices would be rising. So this is kind of hard. So what we did, we used option strategies, like a put option strategies, without really implementing these options themselves, because they can be expensive depending on the volatility of the market and so on. So we started replicating these options, and this is what we're still doing.
How can you replicate those put options? Like, what do you actively do in your day-to-day?
Actually, that's not really hard. Most people that are familiar with options know that options have a delta, and this delta is the sensitivity to the underlying. So what we do is we calculate deltas of the of options, and the delta of these options gives us the exposure in the underlying. So as long as your underlying exposure equals the current delta of your option, and you adjust this allocation on a daily basis, you pretty much get the same payout profile as the option itself. So it's not really rocket science. I would even say it's common sense in the financial industry. I think what's different is the idea of implementing this approach into a portfolio management context, because this replicating options or delta hedging is more like a trader's approach to hedge his open exposure when selling options. So the cool thing about this is implementing this approach into portfolio management context.
So basically, on a daily basis, you're buying and selling stocks.
Yeah, using passive instruments. Yeah.
What would be a passive instrument, like an ETF or?
Yeah, something like you could use ETFs without problems. A daily adjustment with ETF would probably produce pretty big costs. So we rather do this with futures, with index futures, with interest rate futures, which are close to free. You have a small ticket charge, but other than that, you can keep your trading costs really, really down over the path of a year. So you could do this with ETF. It's more expensive, so I'd rather do this with using futures.
Okay. Then do you have any particular indices you like to trade on? Are they particularly well behaved for this portfolio insurance kind of trading technique, or are there pitfalls when you use others?
If you work in a forecast-free environment, the only thing that you would be looking for is getting your volatility of your underlying asset down. And you do this by broadly diversifying your underlying. So we're not looking for any indices in particular. We're just looking for global fixed income and equity portfolios that are diversified in the best possible way. Because if we have an equity portfolio with the lowest possible volatility, our insurance costs using option replication will come down due to lower volatility of the underlying asset. So diversification is the key to bringing down risk in the underlying and to lowering your portfolio insurance costs of your overall strategy.
Because you have to rebalance less often and hence you reduce the trading costs? Or how do you reduce?
Yeah, it's more, the key is more in you find the key more in the option pricing theory. So volatility will bring up your cost of your option. And since we're replicating an option, the same thing is true for your portfolio of the underlying asset. So it's not the trading frequency, but it's the volatility of your basket that helps you bring down portfolio insurance costs.
Okay, really interesting. Let's deep dive a bit into option theory, just what's behind it. Why? Can you explain a bit on which option theory you're pricing?
Basically, we use Black-Scholes to price these options and to extract the delta. So yeah, this is also common sense in the financial industry. There's no magic formula behind that. We're just using common knowledge to price an individual option that we have been creating to get most out of a global multi-asset portfolio. Yeah.
So basically, you are creating your own options on a global multi-asset portfolio. Do you have a counterparty for that, or is it just a fictional option that you're using?
It's basically just a fictional option. Yeah, no counterparty involved.
Okay, but then Black-Scholes is from which year? It's pretty old. Isn't there something newer, more modern that is maybe more relevant or more accurate?
For calculating the price of an option, I wouldn't think so. No, we still stick to the old proven knowledge. Yeah.
Okay.
So what we also see is that people selling options, pricing options, they all use the same methodology, and therefore it makes a lot of sense to use methodology that the whole market is using for pricing options.
They always told me they also think about things like skew and kurtosis, and Black-Scholes does not take those into account. So they basically have the volatility smile. Mm-hmm. Is this something you're also using, or you just use the plain option formula and extract your values from there?
We use the plain option value, and that has a reason, because we don't need to be that exact when replicating this option, because we're actually not hedging an underlying asset where you really need almost like a perfect hedge, because this will have a big impact on your trading book. But there's no need to be that exact, because we just extract our asset allocation from this theoretical option. There's no match to our portfolio. There's no need to match the option in the portfolio. And at the end, there's so many other factors that will have an impact on your tracking error between the theoretical option and the real portfolio. Like trading, like the option will react to the market in the same second as the market moves. But we will not be able to replicate the option, every second. We would have to adjust the portfolio every second. So we will create some kind of tracking error to this option, and this tracking error is still small, but is still a lot bigger than what we get not being exact on the option calculation.
Okay, so basically the trade-off between having to rebalance every second and having just a decent tracking error is in favor in this case for less accuracy, but also less trading costs. And you do basically a Pareto analysis, like what are the 20% that produce 80% of the results. And you live with that, because in trading, it's very important to be very accurate. But in investing, as you have a portfolio horizon of probably several years, you can allow those small errors as long as you do something that is better than the market. Yeah,
that's exactly it. Yeah, it's not even that we adjust on a daily basis. We work with with thresholds, and so there might be times where we don't adjust for a couple of days because delta hasn't changed a lot. So as you said, getting more exact on the option, this is like 1 or 2 or 5%, but the trading part, converting the option into the real portfolio, that's like 95%. So it doesn't make so much sense.
Okay, fair enough. But then I wonder if this approach, or what did make you think that this approach is superior to predicting the future? Like, did you have any outperformance over the return that you wanted to produce, or did you saw at active or other passive investments like ETFs?
Good question. First of all, about predicting the future, I mean, I've been a fund manager for 14 years. I have seen so many portfolio managers, and they're all cool guys, but I haven't seen anyone who could predict the future. Not at all. And I think there's a lot of proven analysis and data from the past that there's a lot of coincidence involved, in outperforming over a certain period and then underperforming in the next. And then you have all the cost problems that you get on top of that. So outperforming the market using forecasts, I don't see why this would happen. Now, outperformance regarding the things that we're doing is a little complicated, because we don't have a benchmark in terms of an index or another portfolio. We could outperform in terms of a better risk return profile, achieving similar returns of like a static portfolio with less volatility, with smaller drawdowns. So our benchmark would be more like risk return profiles. This is what we're trying to do. Our assumption is that there's a risk premium for bonds and equities, a long-term risk premium, and we try to earn this risk premium with the lowest possible risk. Yeah.
What would your risk return benchmark be? Would you compare to an S&P 500 or to a bond or to just a multi-asset fund in general?
You could imagine this like you have an equity portfolio with a risk premium of, let's say, 4 to 5% over long term. And you get this risk premium with a 100% global equity portfolio with a volatility of around maybe 20%, sometimes up to 80, sometimes a little lower. And you will experience maximum drawdowns of 40% like in 2008, 2009. So in this example, our goal would be to achieve these 4 to 5% risk premia over money market in the same period of time with half the volatility, a quarter of the maximum drawdown. Yeah. So that this would be in this case the benchmark. Yeah.
So basically also, because at the beginning you said predicting the future, but then there's ETFs and index funds out there that are trying not to predict the future, but you still try to outperform basically, or to, in risk return perspectives, try to outperform even passive index investing. Is that correct?
In a risk return perspective, that's correct. Yeah. So if you have a 50% equity, 50% bond ETF portfolio, and you again look at the risk premium that you can expect, say 1% government bonds and 4% equity, then you end up at 2.5% for a 50-50 portfolio with no cost involved, of course, at this point. And you'll experience a volatility of probably around 10% with this portfolio. We want to achieve the same return with half of the volatility, which would be around 5%. So you can take any portfolio, ETF or actively managed, and we will use that risk return profile as a benchmark.
So you basically probably try to use their benchmarks as the indices for your option strategy. Because if they invest in a DAX or a S&P 500 index as a benchmark, you would use the S&P 500 futures to try to replicate or to improve the risk return profile of their strategy.
Not even this. We would not even consider the same underlying as a benchmark. We would in fact only use this risk return profile as a benchmark. Because from our philosophy, we wouldn't understand why you would limit your investment to, let's say, just one or two indices or countries. Why would you have an equity portfolio that only consists of 30, DAX stocks?
Yeah.
So from a risk return perspective, that wouldn't make sense at all, because it's high risk and equity return. If you can get the same with a global equity portfolio, we would always go with the global portfolio. From our perspective, there's no need to constrain yourself, on a global perspective when it comes to building a portfolio, because diversification is obviously bringing down your risk. So this would be an unfair comparison if you have a DAX portfolio, because it's way off regarding risk, and we can have the same return with a much lower risk. You could go the other way around and say, okay, we build a portfolio with a risk similar to a DAX portfolio, and we would on a long term outperform this DAX portfolio by far. Yeah.
But how do you manage risk? How do you decide how much risk you take and how much return are you aiming for?
That's again the option part. Yeah.
Is it possible to say, hey, my competitor they take, as you said, they take 40% risk over a period of 10 years. Now I want to get the same return, but with 20% of risk exposure. Is there a way you can manage that, or? Yeah,
there's two approaches. One would be the investor approaches us and says, I'm restricted to a risk budget. I can't lose more than, I'd say, 2% in 1 year. This is my maximum drawdown for 1 year. And then he has different options to achieve this goal of the 2% maximum loss. And this is where we say, if we have this constraint of a risk budget, we will make the most out of this risk budget. We will make more than a stop loss approach. We will make more than a hedging with real options. We will make more out of this budget, than using, a CPPI or other approaches portfolio insurance. So this would be one way clients would approach us. This is my risk budget. This is my loss limit. Please make the most out of it. And then we say, we will make the most out of this. The other way around would be more like a total return approach, where we have a target return and say, I want to make 2% on average. And the client says, I don't care how you do it. I just want 2% with the lowest possible risk I will be taking. And then we will build this option that has the highest probability of achieving this target return on a midterm basis. And then we will confront the investor with the resulting, let's say, loss limit or risk budget or risk that he should be willing to take to achieve this 2%, which would be for a 2% portfolio today something around 8% maximum drawdown.
So basically, for every investor, you create their own individual option and then implement the strategy individually, or for your whole entire fund of 20 investors? Or
if it's an institutional investor with an institutional fund, then they all get their own options in their own payout profile. Now, with our retirement platform, it's different. It's more like the B2C approach. We want to offer this knowledge to, basically everyone who needs to take care of their retirement planning. It's a little different there. We basically use two funds with two different risk budgets. One has a really high risk budget, one has a really low risk budget. And then analyzing the needs of our clients, we will match a certain risk budget that is between these two funds to the client's needs. And then we will mix these two funds to get the correct risk budget for this particular guy.
So basically it's always a mix of the funds that is according to the level. If the client has a level between 1 and 100, like if it's 50, he gets both at 50%, and if he gets 70, he gets 170%, the other at 30%.
Exactly. Because usually, how do you usually do that? You're analyzing the risk profile of a client, whatever that means for the client, and then you come up with one portfolio out of 5 to 10 portfolios, and then you say these guys that shouldn't take that much risk. They get a portfolio with a lot of cash, with a lot of bonds, with only a small portion of equity. And then you have these guys that can take a lot of risk, and they get all the equity and possibly a higher return over a certain period. Now, from our perspective, it doesn't make sense to define risk for certain asset classes and say bonds are safe, equity is not, and based on these assumptions, build a portfolio. So our approach is to say, this guy can't take that much risk, he gets a lower risk budget. This guy can take a lot of risk, he gets a bigger risk budget. And then we take care of the risk budget. And according to our strategy, you can have some more equity with low risk budget or less equity with risk budget. And with high risk budgets, you might end up not having equity at all in your portfolio for a certain time period, like in 2008 or 2009, and you have all bonds in your portfolio. And then in a good equity environment, you have your 100% equity in the portfolio with your high risk budget. We don't want to refer from the risk of the client that he's willing to take to a static asset allocation that involves an assumption about the risk of these asset classes. That doesn't make so much sense.
Because you never know. Sometimes bonds get into a frenzy and then they hike up, they fall down. Sometimes equity do the same, and sometimes equity are stable and bonds are not. I mean, mostly it's not, but it could be, right?
Absolutely. Especially today when you have 10-year bond yields of negative 10-year bond yields. And then, you have a duration of 7 or 8 years of these bonds. That means if interest rates for German government bonds go up 1%, you have a loss of 7% or 8% in your portfolio with 1% in yield hike. And this doesn't seem so much, because if you have a negative bond yield of 30 basis points or so, 1% yield hike gets you to 70% positive bond yield. And this is not much at all. So even 2% yield hike for a 10-year bond portfolio is more than likely or possible. And this will get you a 16% loss or 15 to 16% loss in your German government bond portfolio. So from our perspective, it just doesn't make sense, to refer from a risk budget to an asset class and assume there's low risk asset classes and high risk asset classes, because it changes.
That actually makes a lot of sense to me. But are there some certain market phase where your strategy works especially well or especially bad? Because you said you can't predict the future, but is this an approach where you can predict the future?
You can predict the return that you will make with our approach if you know how the markets will perform. So for any given market environment, we can tell you what you could expect from our approach. But of course, we don't know where the markets will go. But it has a very important advantage. We can test this approach in any possible way, using index or market developments or creating market developments that will probably never happen, but we can still tell you what would happen with your money if it's managed via our approach. So regarding different environments, it doesn't work well. There are environments where a portfolio, like an ETF portfolio that is really passive, will definitely outperform what our approach, where it would have been better that you just leave your portfolio alone and then you see what happened. And especially in times where markets have a high volatility, but at the end of a period, nothing really happened. It's more like a sideways volatility. So DAX starts at 12,000 on the 1st of January and it ends at 12,000 at the end of December. And in between, you've seen it rise 1,000 or 2,000 points and go down again. And then it would have been better to just leave the portfolio. I mean, you didn't make any money in that period, but during that period, it's possible that we will have a slightly loss. And that compares to, like a static portfolio, and they would say, why did I do this? But then again, in market environments where you have a really strong upturn or you have a really strong downturn, we will outperform a passive portfolio by far. And it makes more than up for these sideways environments. Yeah,
So you could even do some kind of trading on your approach. You could say, hey, if I expect the market to be sideways, I'm not going to invest, or if you expect it to rise or go, but it wouldn't be it would be against the idea behind it.
I guess you could do this. And I know of colleagues that have been doing this, combining a forecast-free approach with some discretion, expecting a sideways market and then not adjusting according to their basic setup. But from my experience, you're more often wrong than you're right, because you get pulled away by emotions. The whole market also reflects, it's like fear and greed, and these are the same. It's the same impact that will lead to an adjustment of your basically forecast-free approach. And most of the time you will be wrong. So the best experience and the best returns you get if you just let it be. Of course, if you get it right afterwards, that's great. But if you put your money on red and it's red, then you double your money. That's also great. So I wouldn't do it.
But the long-term odds are still against you, basically. But one question, you said you would outperform in a downward market. Would that mean, as it's a total return strategy, you would perform positively, net positive, or still net negative, but far less than the market?
It's long only, so we will be negative, but far less than a portfolio that's just passively sitting there. Yeah.
Okay. So, but is there also a long and short strategy of the total return?
You could obviously create option profiles that involve short positions, but then it creates a more option-related costs, although you don't use real options, but the costs that are involved in options, they will also be reflected in your replicated portfolio. So you could replicate a straddle, for example, and this would mean that you have short positions of your underlying in your portfolio to replicate this option. But again, it's a lot more complicated, and a portfolio that can also be short instead of just being long is really hard to explain to an investor. Because then it's not like a positive environment, you are more or less positive, or in a negative environment, you're more or less negative. But you will have periods of time where all markets are positive and your return will be negative. And this is, from my experience, this is really hard to explain. From a diversificational standpoint, this could make a lot of sense in a portfolio of different assets and asset classes and different approaches, because it's a nice diversification with such a long short approach. But from my experience, most people will get rid of the long short fund as soon as it has a negative performance and all other funds have a positive performance. And then people don't care about diversification. They just want a positive return.
Okay, so basically, in a even larger portfolio, it's good. It's a good portfolio insurance measures, but in an portfolio insurance only portfolio, it's not as great as a long only.
Yeah, I totally agree to that.
Okay, perfect. Then we've done a lot of theory now. Like, I would really now return a bit to the practicality of things. And so how do you implement that at your company, Evergreen? Can you tell us a bit more what Evergreen does and how do you implement this total return strategy? And also, why do you use it for retirement planning? Why didn't you open an institutional fund?
Yeah, what do we do at Evergreen? We take care of people's finances, of people's financial planning. So the core vision of Evergreen is a service, is a free service to clients. So what we've been talking about, fund approaches and portfolio management approaches, this is really more at the end. It's more the fuel that's gonna be needed for what we actually do, which is the financial planning service. And that's why it's not just a fund, and then selling the fund and say, oh, look, we have a nice fund. It's more about the service. What we want to do is bring people in touch with their financials in a fun way, in a way that they would like to approach their own financials. And we all know that financials is a topic that interests really just a small amount of people, and most people just think it's boring. And basically, it is pretty boring. But it's, on the other hand, it is really important, because you need money today to get food. You need money to bring your kids to college. And when you're done with your work and you retire, you still need money, to live on. So it's a really important matter that most people are not so much interested because it's boring, and we want to build a bridge, between the necessity of financials and people, just being bored with this. And this is what Evergreen is about. We want to democratize financials, and this is kind of a buzzword, I know, but we really want to help people understand how much money they have, how much money they need, and how much money they will have and will need in the future with just a couple clicks. This should be as easy as sending a text message, and this should be as fun as playing a smartphone game. So there's a lot of education involved. We want to educate people in a fun way, and then really at the end we can use our portfolio management approach to take care of people's financials. So this is really at the end.
It all sounds, from a theoretical point, very enlightened, right? But there's already so many platforms, so many websites, so many robo-advisors out there. Are you just the next one in this huge basket of eggs, or what differentiates you? Why do you think you will succeed in this approach, or what does set you apart?
Yeah, basically two things. One is that we really care about what we're doing for the client. We're not trying to sell a fund. We're not trying to sell a product. We're trying to take care of people's financials. So it's not like discovering a retirement gap that says, oh, you should save another 200 euros a month and put this money in our product, but to take all the contributions to your financial health into account, and not only once, but basically the whole life of our users. So taking into account what they already have on their bank account, on their investments. Do they have a Riester savings plan, or do they have a so-called vermögenswirksame Leistung? Do they have a company retirement plan? Do they have real estate that will generate income for them in the future? So everything that costs money and generates money, we want to take everything into account to deliver the complete picture for these for our users. And this, ongoing, not only today because it changes. Maybe you do have real estate, but today you're paying for real estate, and someday you're done paying for real estate, and it generates rent and additional income, and your income is rising, or I don't know, you get fired, you don't have an income anymore. So we want to deliver the whole picture, and that's the basic difference. Not just a retirement gap and do the 200 euros now and put it in our fund, but delivering the whole picture and being there during the whole life of the client. So this is the first. This is our basic service, and this is free, and we want to have an impact on society with this, taking care of people's financials and educating people in financial matters. So this is the first thing. And the second thing is that how can we deliver this, or how can we have an impact with our product itself? What differentiates us product-wise from a robo-advisor? First of all, simple, it's cost. I think robos are doing a great job in bringing costs down and promoting investments in ETFs. I think this is a great thing because ETFs do save a lot of money, and costs are the biggest return killer there is. And with high interest rate environments, it was always easy to hide all your costs that are involved in an investment. And now it's not so easy to hide all these costs. So it's a great thing that robos are advertising ETF and ETF portfolios. I personally think that the service fees are still at a high level. Overall costs on average are probably at around 1% per year for robo service, including funds and everything. And 1% is a lot. I mean, we were talking about risk premia for bond portfolios of 1%, probably not even that today, and of 4% for equities. So if you don't have a 100% equity portfolio, you don't get the 4%. If you get 50% equity portfolio, you only got the 2% risk premium. So now you take away from these 2%, you take away 1% of costs. It's 50% of your returns. It's still a lot. And so I personally think costs need to come down even way further than we've seen it today with ETF portfolios and robo-advised ETF portfolios, because otherwise there will be not enough left of your return. And the second thing is, I think static ETF portfolios where you can choose from 5 portfolios can be dangerous for the reasons that we've been discussing before. I don't think a bond portfolio is a low risk portfolio. And I don't think you should have a 100% equity or 80% equity portfolio, even though you can take a lot of risk, but you're in an environment like 2008 and 2009. So I think there is something behind, or there's a next step behind passive. And for us, this is passive dynamic. So no stock picking, because we can't predict the future of companies and markets. This is good, and this is what ETFs do. But I think it's also important to manage risk in these portfolios in a different way. Our way is risk budgeting, so people know I won't lose more than 1%, 2%, 3%, even if bond yields rise 3 or 4% in a year, and have a dynamic asset allocation that is risk managed. So for us, this is the next step after passive.
And this can be done very cheap, because you described the option that you described is done via futures.
Yeah, exactly. This is where we can lower costs significantly. ETFs are inexpensive; they're really cheap, and they're a great tool. But you could bring this down to almost zero at least from a portfolio management perspective. So instead of paying ETF fees, we can lower our service fee on the platform, and that brings the cost down to below 50 basis points all in for a risk managed portfolio that is still individualized.
Is there anything, like any market environment, any trend, like anything that could entirely screw up your strategy? Like a black swan event that you might not even have to predict? Or do you think like your returns are pretty much always in this risk budget that you have?
There's an environment. If we all go to bed today and tomorrow we wake up and equity markets open 80% lower than the day before, that when they were closing. So then we would probably exceed people's risk budgets that we're defining by, let's say, 50% or so, which means that if your risk budget was 3%, then you actually lost 4.5%. So in this awkward scenario, we wouldn't reach our own goals regarding risk budgets, but you will still be very happy to be invested with us because you didn't lose 80% of your money. Yeah. So this would be a scenario. Same thing for bonds, of course, but I don't see how bonds they're not going to lose 80% as the government bonds. Well, they could if the government or the country is bankrupt, yeah, of course. But we mainly rely on German government bonds, so let's hope we're not bankrupt overnight. I
wonder then, how is it possible that everybody is investing into the strategy so far? How is there institutional investors investing into ETFs, into active funds? This to me sounds like a total frenzy, like a logical thing now that I should put all my money in a total return fund. Why are there so many very smart and sophisticated people out there not doing it? Yeah,
I mean, why isn't everyone driving a Tesla when it's a self-driving car that doesn't need gas? I guess there's different expectations for your investment. There's other return sources than just the risk premium of or the market premium of equity and bonds. So there is return behind market beta. There's like smart beta approaches. There is people that believe in alpha, and I guess there is alpha sources that are discretionary managed, especially in very small markets like small cap equity, where you can have an information advantage. So managing pure beta, I think we have probably one of the best approaches, but there's so many other return sources that you could add. And that's why there's so many other products that totally make sense. Yeah.
Okay, perfect. I think we can leave it at that. Now I want to wrap up, just to ask some personal questions, is there any books that you could recommend young people that they should read, or is there any particular course or anything they should learn about if they're interested in investing?
I would always recommend Burton Malkiel with Random Walk Down Wall Street. Probably most people in financial business have read it already. Yeah, I think that's an eye opener for people that are not familiar with finances and still believe in the investment god or so. Yeah.
Oh, that's actually a good hint. Is there anything, like any really bad advice that you've heard that people believe to be true or that people follow?
In the financial context, you mean, or in general?
Both, if you would like to share.
It doesn't make sense at all to follow, some guru guy that seems to know where markets go. We've seen this so many times with some funds and star managers. They're so hyped 2 or 3 years, and then nobody wants their funds anymore because it turned out that it was all a coincidence. And from a statistical point, it totally makes sense that there's portfolio managers that are right several years in a row, because imagine, you have 500,000 portfolio managers and they all roll dice or throw darts. I mean, there is a certain probability that there's a whole bunch of them, getting it right a couple years in a row, and it's still statistically just a coincidence. So yeah, best advice would be don't follow any guru portfolio managers. This is all marketing.
If you could give yourself some advice, like your 20-year-old self, what would you tell him?
Well done so far. Keep going. I would probably do most of the things I would do the same way that I've been doing.
That's a great answer. I think we'll leave it at that. Last question: is there anything you want to get out to listeners? Anything you want to bring across, or how can they reach you if they have more questions about you or Evergreen?
I'm on LinkedIn. I still have a Facebook account, although everyone tells me that Facebook is dead.
Perfect.
And of course, you can visit our website at evergreen.de.
Awesome. Perfect. Thank you so much. This was very interesting, Ivan. I'm looking forward to talk to you next time.
Yeah, thank you. That was fun.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.